The results are in. Nvidia's earnings are on deck and they were very good, lifting most of the market in after hours trade. But when the market rallies after a few consecutive down days, we need the subsequent rallies to do certain things. Now the question remains, did the S&P 500 do the right things in today's trade to warrant further bullish price action tomorrow and through the end of the week? Or is this just another dead cat bounce? Let's talk about it. Hello, ladies and gentlemen. Welcome to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, guys, please subscribe, hit that notification bell and like this video. It really helps me with the algorithm. Let's get into it. And the market putting on quite the show towards the end of the day, paring a lot of losses, finishing just green for the day. Some of these big names, it was half and half. Look at Google, look at Amazon, look at Tesla. They were pretty green on the day. Nvidia pretty red, but that changed after hours. We're going to talk about why. Technology led to the downside all in all, and the real winners today were commodity sensitive sectors, energy, utilities, basic materials. But let's actually hop on the charts. Now, looking at the S&P 500 right here, the first thing I want you guys to notice is that in after hours, the SPY is up 0.47%. So there's a lot of after hours trade going on there, and that was led by Nvidia. But if we actually go into the S&P 500 on the daily chart, we can see quite a number of things I want you guys to note. Firstly, futures right here, ES futures is up 0.5% after hours. The Nasdaq also up 0.5% after hours. There's some bullishness happening in semiconductors that's really pushing the whole market up. But if we actually have a look at the S&P 500, what happened during normal hours trade, we can see that this was actually quite bullish action. Now we did gap down and then bears did take us lower initially on the day, but bulls saw this area as immense value. We're talking the 49.50, 49.40, 49.30 area, sort of around here. Bears found quite a lot of value and took us all the way up to the high of the day, closing pretty much at the high. And we can see the bulls like this area. We got wicks right here, wicks right there last week, and wicks right here today. So there's definitely amazing value in this area that bulls really do like. What bulls need to continue to do tomorrow is close above this high, close above the open of yesterday, and then on Friday push to close this gap fill. If we can get a gap fill by the end of the week, that's so incredibly bullish considering CPI and some of the macro events we got last week that led to this downside we saw. But it was all in the game. I did say we are in the window of weakness, and in hindsight it was really against the bears because of the shortened window of weakness. Instead of 5 days to work, they really just got 4. Bulls took the opportunity there, or are currently taking the opportunity there. What the bears need to do, I think tomorrow is probably their last day. They need to push below the actual open, and then on Friday push below the wick right here and take us to this 49.20 area. Otherwise, with the way this is panning out, with what we're seeing in semiconductors and Nvidia, I do think that we probably are going to go higher, close this gap by the end of the week. Now guys, we're going to talk about earnings and we're going to discuss Nvidia very obviously, but quickly before we do that, I want to talk about Palo Alto, Solar Edge, and Teladoc. These like hyper growth names that came out, reported earnings yesterday. I didn't cover it in yesterday's video, but they all dumped pretty hard on very, very soft earnings. I believe Teladoc had soft earnings, same too with Palo Alto, weak guidance, Solar Edge as well. They were all down anywhere from 10 to like 22% plus in after hours trading. So we're definitely starting to see some real softness in a lot of these hyper growth names, and it's definitely going to be something to watch for the rest of the year to see what these software tech names produce against the names like the Mag 7. Now let's actually talk about Nvidia. We got blockbuster earnings from Nvidia. They reported revenues 22.1 billion, beating estimates. Earnings per share came in at 5.16, beating estimates as well, and data center sales were up 409% at 18.4 billion. And this is what really matters. This is what's driving Nvidia's revenue growth above every other segment in their business. Forward guidance 23.5 to 24.5 billion for Q1. That's actually a beat and raise here on revenue just on the quarter based on this quarter. And then we're actually expecting gross margin of 76.3%. So a great quarter here from Nvidia. And this is how they make money, guys. You can see that the majority of their money comes from data center revenue based on the cloud, AI, and everything in that segment. You know, these H100 chips are selling like hotcakes. But then we also had a mild uptick in gaming revenue as well as other revenue. So it was a beat across the board. All segments in Nvidia actually rose, especially a lot of people were talking about this gaming segment actually decelerating quite significantly. They were talking about that in this quarter as well as this quarter, and we just actually haven't seen that. Gaming revenue has slowly been increasing quarter over quarter. Now, looking at how Nvidia actually makes its money, now you can see here, guys, that data center revenue accounts for the majority of revenue, as well as gaming, professional visualization, automotive revenue, and then OEM and other. They have gross profit 76%, and their margin is actually expected to slightly increase. They're looking at 76.3% in Q1, and then all in all, they convert $22.1 billion worth of revenue into $12.3 billion of net profit, and that's a 56% margin. That is so healthy. I think Visa have a 54% margin, and they're one of the highest margin stocks ever. So these semiconductor chip designers like Nvidia, they actually don't manufacture the chip, they just design the chips. TSMC manufactures their chips, but it's such a high margin business right now for Nvidia. Now, after hours, what actually happened, the stock was up 6.41%, and I do think we're probably going to rally. We're probably going to continue this rally all the way to the 700 area. I think we might even go to 750, 800. I think both have a price target of 800 there on Nvidia. So you normally see these pops. We can normally see like a mild retrace the next day, a couple of percentage points before we see continuation, especially with a beat and raise on the quarter. So do expect Nvidia to continue higher, do expect it to lift all semiconductors higher, and do expect technology as a whole to follow Nvidia forward. Now, looking at sectors on the day, guys, and look at what were the best performing sectors. XME, XLU, XLE, these commodity sensitive sectors, driven by oil or electricity or water or metal and mining prices, they were the real winners today. The SPY put up a flat day, just slightly positive, but more sectors beat the SPY, actually lost against the SPY. The only ones that did lose was semiconductors, technology, regional banks, GDX. But you can actually see here that, towards the end of day, they pared so much of those losses. Actually, most sectors did, but particularly in technology and semiconductors right here, they really led the charge higher towards the end of the day. And I really want to see if this follow through strength continues tomorrow. And I think it will with what we've seen with Nvidia's earnings and technology. I think a rising tide lifts all boats. But I'm also very interested to see what's going on right here. Remember what I told you guys on Monday? Many people were saying we're seeing a defensive rotation into healthcare, into staples. That wasn't the case, guys. We were just seeing a liquidation. People were just pulling money out of the market, getting a bit defensive in terms of just holding cash. And now we're starting to see that money rotate back into sectors at the bottom of the market. And I do think that technology is going to continue to outperform. Nvidia and semis are going to continue to outperform just because of the earnings we've seen. And even look at these median sectors right here. Look at healthcare, financial, staples, industrials, home builders. Like, these were actually really strong on the day, despite what the S&P 500 was telling you underneath it all. Part of the reason why we got that late day rally in tech and, well, most sectors had to do with the Fed minutes. I just got the most important points here. But what was really key was that they said in discussing policy outlook, participants judged that the policy rate was likely at its peak for this tightening cycle, which means rates aren't going to be hiked. Participants generally noted that they did not expect it would be appropriate to reduce the target range for the federal funds until they had gained greater confidence that inflation was moving sustainably towards 2%. So in other words, where the federal funds is right now, 535 basis points, it's just a hold. The meeting summary indicated a general sense of optimism. That's really key. So the Fed is liking where the economy is going, where rates are, where everything is moving towards. The meeting indicated a general sense of optimism that the Fed's policy moves had succeeded in lowering rates inflation, which in mid-2022 hit its highest level. And officials noted they wanted to see more before starting to ease policy. Yep, we get it all. So in other words, we like where things are going. We're not going to do anything just yet. We're going to keep rates as they are. What did that do for a Fed fund rate futures? We're still expecting the first cut in June with a 54% probability. Otherwise, it's looking like a hold all the way up until June. To be expected, the market, the economy is really hung in there, despite all of the headwinds we faced in 2023 and CPI last week, the headwinds in 2024. Now guys, some really interesting data we got from Bloomberg. This is essentially hedge funds, their returns, and the performance fees from their fund managers. Now the reason why this caught my attention was because Bill Ackman, I like keeping track of what he does. I think he's a great investor. And he came in here at number 7. He raked in $610 million in performance fees. Now this blue shaded area right here is gains on personal investments and then share of performance fees. And as you can see, these hedge fund managers are raking in so much fees, guys. And I don't really think it's worth it because we actually got some stats right here. 85.61% of funds, let's call it 85% of funds, underperformed the S&P 500 in the United States. Only 14% beat the S&P 500, and beat by how much? And I wonder what this looks like when compared to the Nasdaq 100, the QQQ. You can go and pick up these funds for a fee of 0.1%, and you won't be paying 25% plus of your profits as a performance fee. And you can outperform not just the majority, the vast majority of fund managers. So don't be fooled by fancy hedge fund terms and trying to extract alpha that's not really there, guys. Keep it simple. Just invest in the SPY, invest in low cost index funds, and you will beat the majority of funds. Some more big news we got, guys. This is actually really big. Amazon is set to replace Walgreens in the Dow Jones Industrial Average. It's going to be added to the benchmark on the 26th. And Uber is also going to join the transportation index. Now, this is really big news. So I got a little bit of data here. And in 2020, CRM or Salesforce actually replaced ExxonMobil. And this is the returns they've had ever since. So this was the date when CRM swapped over for ExxonMobil. The subsequent returns for the last 3 years, ExxonMobil has returned 203%. CRM has returned 5.04%. Now, this is sort of like a timing issue. And I do think that if you do look really long term, Salesforce will outperform ExxonMobil, but it's just really interesting the timing of these. Now, is Amazon gonna outperform Walgreens? I don't really know. No one really knows what's gonna happen, but I have had a look at Amazon's fundamentals, and to me it is a little bit pricey, but that's because the market expects big things. Now let's talk about the macro more specifically. This is the LEI, guys. This is the leading index. Essentially one of the most accurate leading indicators to predict a recession. We could see it did so in 2001, 2008, 2020, and this normally occurs when the indicator gets into deep contraction territory. And this is where we are right now, yet we still haven't had a recession. Now, the conference board came out and made a statement a couple of days ago, and they said the LEI fell further in January as weekly hours worked in manufacturing continued to decline and the yield spread remained negative. While the declining LEI continues to signal headwinds to economic activity, for the first time in the past 2 years, 6 out of its 10 components were positive contributors over the past 6-month period ending January 2024. And as a result, the leading index currently does not signal a recession ahead. While no longer forecasting a recession in 2024, they expect GDP growth to slow near 0% over Q2 and Q3. And compared to what Goldman Sachs is expecting of 2.4% and GDP now at 2.9%, it's looking like the LEI index is actually going to produce its first false signal, but it actually won't be its first. The LEI index has actually been reconstituted quite a number of times to reflect past recessions. It was reformed in 2011 and I believe in 1993. So take this indicator with a grain of salt. It places a high weight on manufacturing and the yield curve, and I think GDP spend, government spending, and consumer spending are far more accurate indicators of what the economy is going to look like versus manufacturing, what it currently looks like, and the yield curve. Now, let's actually talk about the returns we can expect if we do get into a recession. Now, I showed you guys this last week and we saw some very interesting stats. And the reason why we do get substantial drawdowns in the S&P 500, normally anywhere in the range of about 30 to 31% in the S&P 500, is because during recessions, we see earnings degrade quite a lot, and then at the same time we see PE compress, and these two together create substantial drawdowns in the S&P 500. Are we seeing that in the current market? No. Earnings are actually really good right now. S&P 500 earnings for the past quarter, the fourth quarter of 2023, is at 13.2% excluding energy. That's double-digit earnings. Including energy, we're sitting at 9.6% right now. So as it stands right now, guys, there's no reason for PEs to compress or the S&P 500 to have a substantial drawdown greater than maybe 10% or so, simply because where earnings are there, we're getting the earnings, we're getting double-digit earnings, we're getting exactly what we wanted to when we're beating expectations by a mile, because earnings expectations just 3 weeks ago was negative 1.7%. Now, just for your knowledge, what should you invest in during a recession? This is just some really interesting data from Morningstar. Now, we're not actually going to look at this. We're going to look at this right here. And the best performing sector out of all of these 4 timeframes. So we got the COVID situation right here, the GFC, the tech bubble, and the recession of the early 1990s. Now we could see here that out of all of these, the number one performing factor is actually quality. The worst is actually value. And then the second best, you're looking at like minimum volatility and then high dividend yield. So this is really where you want to be. If you could sort of get like high quality cash producing assets, that's sort of where you want to be during a recession. So just something for your knowledge in case things do start to turn at the end of this year. Now, where should you put your money right now? Now, this is cyclicals versus defensives. And you can see on this chart right here, the higher we go, cyclicals tend to outperform. Cyclicals are stuff like technology, financials, industrials, consumer discretionary, semiconductors, and then defensives is like staples, utilities, healthcare. And we can see here that in almost every single country, cyclicals are starting to outperform, particularly in Japan. Japan's cyclicals are absolutely on fire right now. But for the most part, based on this trend right here, where you really want to be is in cyclical sectors. Now, also looking at momentum, again, this chart shows the higher we go, momentum outperforms. And we can see that it definitely pays to be in momentum at the current level across all indices, maybe except for Europe. Europe tends to be pretty flat, but we are seeing a tad bit of outperformance here in momentum. Now you can see here that for most of these indices from about June 2023 to about December, momentum performed in result with the market. Why is that? Well, because what momentum was doing and what the market was doing was aligned. When you say momentum in 2024, you're actually looking at stuff like technology, semiconductors, consumer discretionary, and they were really the leading the market forward. They pretty much were the Mag 7 or the Mega Cap 50, as you can see right here. Then we got this broadening out in the market. And during this broadening out, we didn't see sell side in tech or semiconductors. We saw everything contribute to index gains, and that's why we did see momentum outperform the market. But this doesn't mean the market wasn't performing well. It just shows that momentum was outperforming the market as a whole. So it's very clear that the place to be in 2024 is momentum as well as cyclical sectors. When the macro changes, obviously this is going to change, and the big macro events this year will revolve around Fed policy as well as the election. But until then, buy cyclical and buy momentum equity exposure. So the sectors with the best momentum in 2024 and for most of 2023 have been the Magnificent Seven, excluding Tesla. And while many people think that this brand of stocks is overvalued or in a bubble, actually on a price to earnings growth basis, they're actually cheaper than the 493, the S&P 500 as a whole, and the S&P 400. So on a price to earnings growth basis, they are actually relatively cheap. But let's switch gears and talk about Gamma. Guys, not much has changed in the Gamma heat map. What we are starting to see though is that this Gamma flip zone is moving up the tape while this 5100 core Gamma resistance is staying where it is. I really did think it was going to move lower after the dump we saw on Tuesday, but things are becoming increasingly tight for the bulls. Really what bulls need to do now is hold this 5,000 level, or we're going to move into a negative Gamma environment, and then we're really going to see volatility start to expand. And we're already starting to see that with the amount of negative Gamma that has come into the tape. We might even see this strike right here, the 4,800, the put support move up to the strike, and that could be a bit of risk to the market, because then we actually might move to this 4,800 strike as to have market makers hedge their books. So guys, according to the options market, there is quite a lot of risk building in this market right now, but we are still ever so slightly in positive Gamma. And guys, do expect volatility over the next few days. The tape, the options market is telling us this. Now, looking at the seasonal performance for February so far, in yesterday's video, I said we can expect a bit of a dead cat bounce. That's exactly what we saw, especially with that late end of day rally. Now, does this turn into further strength to the upside? Well, in after hours, it's looking like it is at the current moment, but do understand that the general seasonal performance is for us to go lower in February, but we do have to be aware and vigilant of what's going on. Nvidia smashed earnings, all of tech is rallying after hours, including software, semiconductors as a whole, and we actually did see quite large participation in the market today in terms of all of the sectors and the majority of stocks, especially in the S&P 500. So do be vigilant that this dead cat bounce, as some would call it, could actually turn into a rally. So don't be surprised if we do see that. And also don't be surprised if we do go lower. We are still technically in the window of weakness, and there is about 4, maybe even 5 days left in this window of weakness. Somewhere around next week, Tuesday, next week, Wednesday, that's when we sort of exit the window of weakness. Now let's talk about stocks, and this is the advanced decline line against the S&P 500, and you can see that the advanced decline line is acting exactly as it should We made a low right here, which is the low right there. And we can actually see that we haven't broken that low. So in terms of the market moving lower with the amount of stocks moving lower, we're actually in line. Now, if we do see an uptick over the next couple of days, we should also see an uptick in the advanced decline line. And I am confident we get that with the breadth we saw in the market today. There was actually fantastic participation, and this is really what you want to see in market rallies. It is the sign of a healthy market. Looking at the equal weight, guys, and you're going to see a theme, a trend. These are absolute key levels that bulls had to hold, and what are bulls doing? They are holding. Now the RSP looks very, very strong. We gapped down. We did have price discovery with this wick, and then buyers came in, took us all the way, pretty much closing the gap on Monday's sell-off, and the RSP looks very, very strong. I do expect continuation in the RSP to break these highs even, especially as we held this 158 level. This is very, very constructive price action in the equal weight. Now, this is the Nasdaq 100. It is looking a lot weaker than the equal weight, but it has run up significantly more. But the key level to hold is this 17,209 level. The Nasdaq 100 is up 0.5%, if not more, by the time of recording in after hours right now. What I really want to see the Nasdaq 100 do before Friday is close this gap right there. If it can go do that, reclaim this high, close this gap, that's going to be very, very bullish for markets as a whole. What do bears need to do? They need to break below this line. They need a convincing close below this line and continuation further. That's what the bears need to do. Are they going to get it? I don't think so. Not with what Nvidia is doing. I really don't think they're going to get that. Now, looking at mid caps, I think this has actually been the strongest sector out of everything. Well above the line it should be holding. It really needed to hold this line, and we actually did get a lot of buy side support, a rally all the way up. What mid caps need to do in very similar situation, go ahead, close this gap, and even by Friday, if they really want to, go and break this high, but that's asking a lot for mid caps. Ideally, what they want to do is just close this gap and finish around this area for the week. That would be very constructive for mid caps. Now, looking at small caps, doing exactly what they needed to do. I said this line is the last straw. They need to hold that. It actually did finish green on the candle. It was a green bodied candle, but down on the day because we did gap down, but a ton of buyers came in the Russell 2000 at this level right here. And again, Russell 2000 needs to go reclaim this level and potentially close some of these gaps that we have here in the market. If it can go do that by Friday, that's super, super constructive. But I'm not expecting too much of the Russell 2000. It has been the weakest sector of late, of most of 2023. So even just to close above that high in the 200 area would be very constructive for small caps. But ideally, what small caps really want to do is go ahead and break this high, because we actually did put in a low here, a low, and with this right here, another low. And it looks like we're putting in another low. So we're sort of following this trend up with this high, and we're doing this. And that's what we want to see with the Russell, to go ahead and break out above this consolidation range we've been in for a while. And then we actually would take a measured move from there to there. And I did this all in my weekend video. Go ahead and watch my weekend video and see my entire analysis of the Russell. It's quite in depth. But long story short, that's what the Russell needs to do. But for this week, let's just close above this high right here, potentially close some of these gaps. That would be ideal. Now, looking at energy, this is a trade I've been in since about mid-January, since about here. And it's starting to pick up steam. There's a big overhead level that the XLE needs to go break, and it's this level right here, the 86.78 level. It needs to break and close above, preferably before the end of this week, if it can go ahead and do that, because this area has given major problems for energy as a whole ever since. So it's going to be a key level to watch and react to see what we do. If it does go ahead, break above, close, use as support, look to higher price action, we can then start looking at levels here in the 90s. Ideally. So yeah, that's what energy needs to do right now. It's break this 86.78 level and then look to $90 area to the upside. Now, looking at semiconductors, guys, I just wanted to point out that these guys are up. They're down 0.64% for the day. They're up like 4.85% in after hours, nearing at the highs, and that has to do a lot with Nvidia and their earnings. And we could see that Nvidia was actually up 6%. This right here is where they currently are. So they closed there for the day. They were up 7% on earnings, and they're probably going to go ahead, break those highs. I do think we probably see 800 in the next couple of weeks. A mild pullback in tomorrow early trade before we continue the rally to the upside. And Nvidia's valuation is really being backed by its earnings. It beat earnings, raised earnings for this quarter. It's going to produce another $23 billion worth of earnings. And yeah, it's the place to be right now. I mean, you don't have to hold Nvidia explicitly, but you need to have some form of semiconductor exposure in your portfolio, because I do think that based on what we're seeing for the next quarter, semiconductors are going to continue to run to the upside. Data in the week ahead, the major data points are done, guys. We had the FOMC minutes. We just have for the rest of the week, we have some PMIs, existing home sales, and initial jobless claims. But if you've made it up until here, guys, thank you so much for watching. If you like this video, please subscribe. Guys, leave a comment, hit that notification bell, like this video. Cheers.